Eh, We are live.
Okay. Hey, hello everyone. Welcome and thanks for coming. And today we're going to be talking about a subject near and dear to no one's heart, which is paying income tax. Uh, so we'll keep that in the back of our minds, but try to mitigate it. And the subject today is going about how to shield your gains from the IRS because of new changes to the IRS rules and regulations, and a couple of new statutes that actually were passed in the last year, which makes crypto taxation somewhat perilous if you don't really know what to look for. So that's what we're going to talk about today. It's really important. So much has changed. It's uh, it used to be that, and this my own theory was, is that a lot of people thought you never had to pay tax on crypto because nobody would ever find you because of the blockchain's anonymity and that kind of thing. But that is like so not true. And based on the things that I'm going to talk about today, and the idea and the new programs that have been put in place, uh, people who are filing their taxes, and especially started now in 25, the returns due in 26, April of 26, with regard to crypto and digital assets. uh, it's kind of perilous, and it's really important that everybody really knows and has a view, a big view, a overview of what the landscape is, so we know how to protect ourselves. So that's what we're going to be speaking about today. And before we get started, a quick disclaimer. Uh, Anything that we talk about with regard to taxes, with regard to the associated AI applications, I'm going to speak about, and they do not constitute legal, financial, or tax advice. These are strategies are based on my own interpretations, and based on my own guidance and my own experience, both as a tax lawyer and as a practicing accountant back in the day. Uh, uh, Laws have changed, but practices have not really changed. Uh, so participants are really urged to get your own tax advisor, get your own accountant. Having an accountant is absolutely critical and crucial. And so this is just for informational purposes. And I'm really glad for those of you who we know from Miracle. I'm really glad that you're here, and I'm glad that I can at least add this information on, so we can all protect our assets, which is really what we've all been wanting to do. So what's new? Well, first off, the honor system as we know it, and I call it honor system because a lot of people didn't think they really, we used to think we were on our we were on our own with regard to what we put down on our tax return, primarily because so many people there were, what was the odds of getting audited or that kind of thing. And um, and that spilled over to the early years of crypto. Well, that's changed. It's changed, especially in the last year. um, and what I call the Wild West era of invisible digital wealth is over. It's finished. And the IRS is doing some really kind of interesting, I want to say nasty stuff, but they're entitled to do it. It's part of the law. And we as taxpayers really just need to be aware of it, and we need to be cognizant of how we can work around it. Um, Now, I'll get into more of that in just a second. And the bigger picture of today to take away with is that the IRS has really replaced human agents, which is was the primary interface with us in terms of being audited and tax returns being reviewed, have been replaced and are being replaced very quickly by AI. And that is a scary thing if you know how powerful AI are. They've added over 300 new specialists deployed specifically just to track digital assets. And 300 might not sound like a lot, but when you figure the power of AI and the things I'm going to talk about, it's really, really quite significant. And all of that in at the same time when they've had, because of budget cuts, a 25% reduction in the workforce in the Internal Revenue Service. That's 75,000. They have 75,000 less employees there now than they had a year ago, which is amazing. But I think they're because of the programs they put in place, it's going to be, it's just become a different game. And their goal, the one single goal, is maximize revenue. So anything, we're going to talk about that in a minute, about why that is and how they're going to, and more importantly, how they do it. But the bottom line is it's become a numbers game for the IRS. So the bigger gain, the bigger amount that they can find and recover, well, that's what they're going to be targeting. And AI can do that. So a lot of you, of course, know me, but just for purposes of the presentation, I'm a retired tax attorney from New York City. I have a LLM, which is like the equivalent of a master's degree in tax law. I spent over a decade in a high-level tax practice in New York City and in accounting. I worked for a big 8 accounting firm in New York, and I did some small firm at the very beginning of my career, a small firm tax preparation. I've been, as a lot of you know, an active crypto investor, and now I'm seeing something that is that has really raised my red flag. So we're gonna. That's why I'm really here today, and I've also created a new company called the Crypto Tax Authority, which is the foundation for the educational programs that I'm putting in place. And also, you may know, I am not a marketer. I don't like to market. I'm just doing this because I love to teach, and I think the education is so much more important than anything else, especially in this area. So, what's changed? Well, for one thing, the new laws that were enacted created a new form, 1099 DA. And some of you may have received this 1099 form already, and that comes from regulated exchanges, the centralized exchanges like the sorry, like the Kraken and sorry, like Kraken and Binance. They are required by law to provide you with a 1099 form. It's the equivalent of the kind of 1099s we get from we have interest or dividends. And that's changed everything, because the anonymity of investing in crypto has changed and has gone away. There's something called a zero cost basis trap that you're going to hear me talking about. And that is that under the new rules, if the taxpayer, the burden of proof has been shifted to the taxpayer to prove his basis in any transaction. And since the exchanges will be reporting every transaction, if we don't report a accurate cost basis for that transaction, it is assumed, and we have the burden of proving an accurate cost basis, will be zero. That means that we would be taxed on the entire amount, the entire fair market value, whatever we received on that transaction. And that is huge. As I already started to say, they have started a multitude, 3 or 4 major AI enforcement agents put together, not just with regard to crypto, but with regard to all of the activities that we with all of the activities that basically into our entire lives. And as some of you know, um, and being in Miracle, um, with what we've done with regard to credit credit scoring, where a lot of that scoring takes place based on internet activity, and in that case, with regard to blockchain activity through AI, all of those things are able to be tracked much more fluently and become much more apparent, and therefore we become much more exposed. The other thing is that's happened is because of the huge deficits we are in, the country has experienced. One of the prime they want there's no I thought this for a long time. I've not seen anything official, but I've read about a lot. I've read about this in a lot of different places. That one of the big under the behind the scenes mandates is that they want to increase revenue by as much as they can, and now there is this huge uh, potential for additional tax revenue because of all of the crypto transactions, especially those that have been previously been unreported. And so there's a huge income factor here that the government is now trying to take advantage of, and a lot of what they're doing now is based. It's almost like a business. How much can we collect? Business collection agencies go after the accounts, obviously, that they feel they have the best chance of collecting from. Well, that is exactly what's happening with regard to the IRS. They're going after the biggest fish, those with the biggest um, those with the biggest trail, so to speak, and biggest possibility of return. Um, and then the thing that is not yet here, but is right around the corner, is that DeFi is next. Now, there was a law, and it was proposed under regulations that DeFi exchanges would also be subject to this new 1099 reporting. There was a statute that was passed in mid 2025, which exempted DeFi for now from these reporting requirements. So, right now, DeFi is not part of what I'm talking about. So, things like, which makes Miracle much more valuable and more, the investment opportunity even greater, is that there's going to be a shift, in my opinion, towards more and more DeFi applications, DeFi exchanges, DeFi programs, because right now they are still not subject to reporting. That's not to say that returns and income from DeFi transactions are not taxable, because they certainly are. But what is happening is that there's no mandatory requirement for reporting. So that's just a slight reprieve. But I have no doubt that probably within the next year that's going to change. Um, and even if it takes 2 years, that's something we have to be prepared for. Um, and a lot of what I'm going to talk about today is for us to learn how to be prepared for the future, because everyone on this call has a lot of crypto. They have a lot of crypto investment, a lot of crypto. Um, they have a lot of stake in the crypto and digital assets. So that is why this is so important, and why I really wanted to do this whole program. So, just to repeat and to add some additional things, Form 1099, that's the new 1099 form that I talked about, does not include costs, which is the zero cost basis trap. So the exchanges right now for 2025 do not have to report your cost basis, even if you bought and sold the same asset within the same exchange. So if you bought something on Kraken at the beginning of the year, sold it later in the year, presumably they would have that data. The the traditional stock exchange brokers have that information. Well, they have it, but they're not required for 2025 to report it, which puts that burden on us for 2025, which is a huge, huge, what we're calling a trap. That in 2026, they will be required to report the tax basis. But with regard to that, they would only have your basis if you bought and sold it on the same platform. A lot of times we'll buy something, maybe we'll transfer it to our wallet. Then it'll come back. Maybe it'll come back to the same exchange. Maybe we'll send it to a different exchange. And when it's sold, that cost basis, let's say in 2026, may not be resident on that exchange, and therefore there would be a zero cost basis. So that's another little piece that nobody's really talking about yet, is that especially because of the way crypto works, putting it in cold wallets and all of those things, there's just a lot of possibility for not having the right cost basis, which is what is now puts the burden on us. There's this whole thing about using more IRS specialists, and the absolute reliance now on the IRS on AI. And the IRS is really stripping away blockchain anonymity by linking transactions in two different ways to our KYC records. So obviously the exchanges that we're on now, we've given KYC, so they know who we are. We have not been required to do that for DeFi applications. So we're safe from that respect. But the AI that the IRS is using tracks what I'm going to call lifestyle data. They are able to track if we're making big purchases. They find that on social media. They find that in bank accounts. They find that in all different ways. I wish I don't have the time to really talk about the different ways that they have to be able to find this. I've been doing a lot of research lately into how that might happen, because I would have thought they wouldn't be able to. But there are things that they've been using, John Doe summonses. They look for you on social media. They look for your car loans. They look for anything that that's related to the internet. So, for example, if you bought a car, for example, and you bought it with credit, so the credit's on our system, but maybe you paid the down payment in crypto, they'll find that. And that goes on and on. And what happens is they have a new scoring system, which the more they find, the more puts you at a higher risk for audit, which puts you at a greater exposure. So that is the whole new landscape that we're facing this year. This is not to scare anyone, but it's something we really need to be very mindful of. Now, I've created something which I'm going to go through more in detail, called the Crypto Tax Threat Matrix, which it will explain what your exposure is based on your current activities to an IRS audit. And the other thing I want to talk about is, we're talking about modern IRS scrutiny. One of the things the IRS is doing now is they've implemented a program where they don't even have to audit you. If when a 1099, for example, comes in and says you have $100,000 of gross transactions and you've only reported $80,000, let's say, in addition to them looking at the 80,000 that you reported to see if your cost basis is accurate, they will immediately assess you for the 20,000, because they're assuming, and the law assumes, that you have zero tax basis. So if your records don't match, the 20,000 becomes immediately taxable. And they are now sending out new letters. They're called 2000, there's a letter number after that, 2000 Form 2000, which is basically an automatic assessment unless you can give them the data that they're requesting. So that immediately puts you behind the 8 ball, so to speak. So what we're really doing is we have to we have to start creating reactive filing to proactively protect our wealth. That is what is really going on here. That's the essence of the tax strategies that this program is intended to talk about. But first, you need to know the changing landscape. And I've just given you some of it. I've given you a bird's eye overview just because it's lengthy. If any of you are really, really interested, I have a report that I created through AI, which lists all this stuff. But unless you want to stay up at night, I don't really recommend you reading it unless you really want to understand it some more. So I've created something called the crypto tax matrix, the crypto tax threat matrix. And what it does, it's what I call a strategic assessment of your risk to determine under the new AI environment, how susceptible you are to exposure. Now, I'm going to be sending to anyone on this call a copy of this. It's a PDF that you can look at. You score it critically yourself, and you take a look at. There's a point system. I'm going to go through it really quickly in the next 2 slides, just because I don't have the time to go through it thoroughly. But when you go through it, you'll be able to see how much exposure, how susceptible you are based on your individual circumstances. So, for example, the first thing is, did you receive a 1099 from an exchange? Okay. You might have 2. That would give you 10 points right off the bat. And this is really big. Are the reported proceeds on those 1099s less than you put on your Schedule D, now in the form of 89 something? There's a new form which underlies for Schedule D. But if those numbers don't track, that's a immediate flag that will be looked at. Have any accounts been put on hold? Or any non-KYC exchanges been put on hold? Did you spend significantly more money than your reported income? So, for example, you bought this new BMW. You only make $50,000 a year because you make lots of money in crypto. I think of Micah. Unfortunately, he's not in the United States, but he bought this condo in Cyprus, and I don't know what the income tax is where he is. But if he bought that and hadn't reported all those gains, that would be something that would be very easy for them to find. Did you purchase any major assets, real estate, vehicles using crypto? Did you transfer any funds from an exchange to a private wallet? So you're in Kraken, you send your money to your cold wallet. They're going to know that. And then they're going to look to see if there's anything going out from the other side. Because while they can't figure out who owns that private wallet, as you all know, they have addresses and they can track those. So that's another way that they can do this. Now, this sounds like so 19, what is it? 1998? What's the name of that book? Anyway, it sounds so dystopian, but it all of this stuff is actually happening right now. Did you fail to report any activity inside your private wallets? For example, swaps, or more critically, staking. So, when we stake crypto, that's taxable. It's a taxable event. and we don't, and that would be, if you held that crypto for over a year, that would be long-term capital gain. The income from the staking uh, is not a long-term capital gain, but then you get a new holding period. So obviously, we all have staking now. There are no regulations that I could find on as to whether, for example, our miracle staking would be subject to tax. Don't know that yet, but that's something we really need to take a look at. Um, Now, here's something I don't even know what this is. Anybody know what Tornado Cash or privacy coins are? That's something that if you're using these are kind of mixing services, which I think were actually deemed semi-fraudulent because there was great potential for abuse. I don't really know what they are, but they were included in this report. One of the things are, have you been, if you are reporting staking or mining gains as capital gains instead of ordinary income? And another one that's really nobody really understands at all is the fact that you can, under crypto, you don't have, you're able to buy and resell something within and not have the loss be well, I'm going to frame it another way. In the stock market, you cannot sell a stock and buy it back within 30 days and take the loss that year because it's deemed that you bought it back, and there's a term that I'm actually not remembering at this moment for that. That does not apply to crypto, fortunately, yet. Although there was also another proposal for that kind of thing to be prohibited. Right now, you can still harvest tax losses by selling something that's at a loss and buying it back. But the IRS now has another provision of the tax law which allows them to look at these things based on whether there's economic substance to your taking the loss. So, for example, if you buy something and then 3 hours later buy it back, like, so Bitcoin, you had Bitcoin at 60,000 and went to 50,000, you take the loss. So you can use that loss against other gains. Well, if you immediately buy it back, they're taking the position that you are doing this for tax avoidance purposes. And there is a provision that they can attack that. And that actually will probably by the end of the year or maybe next year be statutory, that you have to wait at least 30 days. That provision has always been in the law, but for stocks and bonds, that provision has always really been the safe harbor rule for stock transactions. So that still remains to be seen what will happen with regard to crypto. Are you claiming your crypto activities as a business loss, Schedule C loss, your expenses? I'm not even going to get into how we treat our Bellator income and expenses from running our Bellator practice. That's something you should be discussing with your accountant, and that's beyond what this purpose of this program is. And the other is using generic software, tax software, that lumps all the tax wallets together. And I'm going to talk more about wallets in a minute. So basically, when you add up all of these things, if you had more than 13, when you went through those 12 categories and you said, okay, I have this category and I have this category and I have this category, and your total was more than 13, that's considered the audit zone. That's considered you being at risk for bringing in an IRS audit, attracting an IRS audit. One of the things is, if you flagged a 10 on question 2, which was the thing about the difference between the amount you reported and the amount the amount that came in on your 1099s, that's an immediate 10. And I forget what question 7 is. It's if you fail to report your activity inside private wallets. That's also critical. So those two things could really subject you to audit. So these are things that I've accumulated based on a lot of reading. Some of it may be academic, and how much of it is practical this year, I can't say. And I don't know, but I think it would be totally remiss not to show or talk about the fact that it is a real possibility. So in whatever we do, we have to keep these things in mind and keep our tax reporting um, to be reflective of the risk we're willing to take. So now, one of the things I've created is and I'm going to be talking a little more about this at the end of the program. The reason I got into this whole thing is whatever I give you here today is just a smattering, an absolute smattering of what's going on and the complexity of this new subject. It literally is the Wild West because so much has changed. It's so new, and there are regulations now, I will say, but the question is how stringent and how strictly they will enforce things. So I just don't know. We don't know. So I've created a 6-week intensive tax education program. It's a paid program. I have spent 3.5 months developing this program. It's 12 hours of lectures and questions and answers of videos, probably be more than that. I've created an AI application because I'm very big into AI. Isatis and I have really we love doing AI, and I've used it for this purpose. I've created what's called an AI agent, or an application actually, that will help you to take we recommend anybody use a tax software service like Calendly, like Coinly, and others to track your transactions. And by tracking your transactions, that's what you would give to your tax preparer or accountant. Well, there are, because of, if you have multiple wallets, Coinly they can't track more than one at a time. They don't have access to the other ones. So it has to be put together. I've created an AI program to help with that, to help you to help get your tax data ready for your accountant. So with regard to that, it's important to know that, and that's just part of what I'm going to be doing. I have created as a separate upscale program, mastermind, to look into certain more unique cases and to help with strategy, how to basically harvest losses and use other means to be able to shield your taxes. But that is a very advanced thing, and that's part of this mastermind that I will be doing. Now, I'm not a lawyer anymore. I stopped practicing when I retired, so I can't give tax advice, but I certainly can give education. And my thing here is to help you work with your accountant. So with regard to that, I've created the whole basis of my tax program, and everything that I teach is based on 4 pillars. One is strategic classification, pillar 1. Categorizing your transactions for your maximum tax benefit. And that's not as easy as it sounds, because you're going to have many, many different transactions. And part of it is just putting all that information together from various wallets. So that's step number 1. Long-term, short-term, capital assets, ordinary income, all of that, knowing the law, the rules. I don't spend a lot of time on this, but I mean, I spend a whole program talking about what's taxable and what's not taxable. Now, usually, what usually we go to our accountant, and and sometimes what we used to do is put all our stuff in a shoebox and come into the accountant's office and just dump it on his desk and say, "Hey, you figure it out." You really can't do that anymore because of the volume of transactions, the complexity of the transactions, and because of he's going to be inundated during tax season. So it's really important for us to do that. The second step is to use AI to optimize the utilization technology that there is to uncover hidden savings. And that's part of this whole process. So we're using AI as a second layer of defense. After we've put all that together, the idea is that we give steps 1 and 2 are based on getting enough information in a really solid place to give to our accountant so he can properly prepare a tax return and properly protect you. Because he can only do what the data is that you give him. And that really is up to you. So steps 1 and 2 are to basically get you to give him better data. Step 3 is something totally new. It's called what I call compliance architecture. It's building a proactive system. Steps 3 and 4 are proactive. 3 is building an architecture system of documentation of all of your transactions to make sure that you can document your gross proceeds and, more importantly these days, based on what I've already told you, your cost basis. And in a lot of cases, if, let's say, you transferred it to someone else, you gave it to someone as a gift, whatever the circumstances are, it's up to you to be able to document that transaction. And that's what compliance architecture is, that if you are audited, your accountant who will go in to represent you will be able to say, here, this is the deal, and you will be protected if you can back up your stuff. If you can't back it up and you can't verify what you said is so, you will be held taxable. The new law is really clear about that. And the fourth thing is proactive planning. So I'm going to talk more about that in a little bit, but just knowing that when we know how much taxable income we have and can rely on that, let's say after 3 months or 6 months or 9 months, we will know how much to basically set aside for taxes. We'll know how much to look to see if we can take losses to offset, and whatever other legal means to do that, to mitigate our tax thing. But you cannot proactively plan unless you've done steps 1 and 2. And you have to do it in real time rather than April of the following year, because by then it's too late. So that's step 4 of the 4 pillars. Now, here's where your accountant comes in. And first of all, if you're going to do any kind of meaningful crypto transactions, you need to have an accountant. Even, I know there are some people who do sophisticated bookkeeping for crypto, and I think that's important, especially if that's something you can't do for yourself. But that person needs to give it to an accountant and not file the taxes themselves. So then it becomes a 2-step process of having someone go through your data and sanitize it. put it in order, and then give it to your accountant so it can be reviewed and filed properly because of the change of the laws. Now, I'm not saying that some people who can or can't do that. I'm just saying that if you have a lot of money at risk, you want to be doing it with an accountant. So the first thing is, as I started to say, I didn't say it just quite like this, but garbage in, garbage out. You don't give your accountant the right stuff, the right information, or only part of the right information, you're going to get bad results. You're going to pay much more than you have to. If you leave it for your accountant to be a forensic specialist, which is kind of like what I'm talking about for the person who's doing your tax, putting your taxes together for you, your numbers together for you. That's what I call forensic accounting. And forensic accounting is about being able to spot in advance the gaps, to be able to spot where information is missing and where you need to make sure you have everything covered. That takes a lot of time, especially if you're a trader and you have a lot of transactions going on. And accountants do not have the time or the staff generally to do that during tax season. And more importantly, in my thought, is if you rely on a CPA to do basically manual book chain data cleanup, you're paying very high rates for something that's very inefficient because he doesn't have AI to help him, and he doesn't really guarantee have your if you've made the money, then you have uh, experience in blockchain and crypto. He, I'm sure, does not have that, or very very unlikely has that. And if he does, he won't know what you've done. So that's why all of these things, it's up to you to give your accountant the right information to keep your taxes at a minimum. So the takeaway from today, this first takeaway is the IRS has changed the rules and it's not the same old game as it was. The second thing is you have to take control of your own data. You have to take control, financial responsibility. I mean, how many of you have heard Tammy and Gretchen saying it's time to take responsibility to learn how to do your crypto and all of those things? Well, that's part of it. Yes, that's absolutely true. The same is absolutely true for this, which is that you have to take responsibility for giving your accountant the right stuff. So whatever that will require of you, depending on your level of sophistication of the volume of transactions, is up to you to figure out to get them the right things. But I will tell you, it has to be much better than it used to be. It has to be more structured, and it um, has to be more carefully put together. It's what I call sanitizing your records, so the IRS, so that you get that to your accountant before the IRS gets to it. Generic software that I was talking about, they will not save you from what we're calling a ghost basis audit, because it just can't. They don't have that ability yet. And they also don't have the ability to track what you do in DeFi wallets and all of those things. So they're a good start, but they are not going to protect you in the long run. And that's exactly why I created the 4 pillars. That's my the way I try to present it. Now, I started talking about this before. We are in the very beginning of March. If you have any kind of crypto tax liability, crypto transactions, depending on the degree that you have them, I have to tell you, I would really recommend, given all of the changes and complexity, you almost automatically consider putting yourself on extension so that you do not have to do this in the next 2 months by April 15th. Now, that's not legal advice. That's just something I do myself. I've always done it. And the reason for that is I highly unlikely, if you have any kind of significant amount of transactions, will you be totally prepared for what you have to present to your accountant. Your accountant can turn around and return in a week or two. That's not the issue. The big issue is putting all this data together. So that's step number one. Now, if you do that, you have to, you should talk to your accountant about estimated, making sure you paid enough estimated tax so you don't have interest. You won't have penalties, but you'll have interest on an underpayment if you go that route and you owe tax liability. But believe me, in the scheme of things, it's probably worth it. Or you just prepay a little and you'll get it back if you've overpaid it when you finally file it. Again, something to talk to your accountant about. The second piece is what I call I started talking about this earlier, and I think that this will become much more apparent. And that is, there are two phases to this whole thing. There's what I call the retrospective action. 2025 transactions are done. The tax year's closed. Nothing you can do about it. All you can do right now, and it's not just an all, but it's important, is focus entirely on cleaning up your data and making sure all the things I talked about are covered to prevent automated penalties. Now, by the way, the IRS there's a new provision in the tax law that provides for a 20% penalty if the automated penalty is more than, it's a complicated formula, but it's more than 10% of something of your tax liability. So if that form 2000 that I was talking about, where you get an automated notice because of deficient, you didn't report the cost basis or whatever, then you could be subject to a 20% penalty. There's a good faith thing there, but negligence is not a defense to good faith. Defense of that penalty, and that could be pretty significant. Not to mention interest, and not to mention other possibilities. So that's for 2025. So I'm saying to you, don't rush to file your 25 return in 26 until you got all your ducks in order. I think that's really good advice. The second thing is what I call that prospective strategy that I was talking to you about in pillars 3 and 4 of my 4-pillar strategy. And that's to what I call shifting to real-time evaluation. And what that means is that as you don't do this cleanup at once in April of the following year. You do it quarterly. If it's a lot, you do it monthly so you don't get clobbered at the end of the year. If you can't do it, hire someone to do it. One of the things I'm going to be doing in this program that I'm doing is going to be a lot of emphasis on AI, because I'm really into AI and I think it's important. It's an important tool. So to some extent, that will help you in doing this. I created an app, as I told you, that will help with that. It's called the Compass 365 Tax App. And I've also created what I call a bot, a tax bot, which will answer your tax questions, not on any kind of legal basis, but basically what I've done is I've fed it all of the statutory and all of the legal things that are necessary to make an informed determination. So you can ask it a question and it will answer based on your data. Now, you could go to ChatGPT or Gemini and do that, but sometimes Gemini makes stuff up. So what I've done is I've included as much relevant tax information as I think is warranted, and I've made that available inside of my app, and that will be available to anybody who's in the program, and a bunch of other things which I'll talk about in a second. And so this prospective thing is two things. It's being able to go along month by month, knowing what your tax liability is, making sure you don't spend your profits, making sure you harvest your tax losses or take any other means that you can when you still have the time to do it. Now, that may change. Everything I'm telling you is applicable right now. In a year from now, I don't know, but we're just talking right now because of the changing tax climate. So it's two-part. The program, which will start now, is going to start in April. Will be finished right at the beginning of May, and it will help you to do your 2025 return and get your 2026 to do your 2025 return and help you for your 2026 return when you file it in 2027. Because I know very easily that when you're making a lot of money, and I think a lot of us may very well be in that place this year, God willing, that we need to really be on top of that. So I recommended to one of my other people to go out and get financial advice if you don't have it. And they thought that was a really good idea. If you don't have a good financial advisor, I really recommend you do that. And I really recommend you get yourself a good, you don't need a tax lawyer for this. That's very expensive. And good crypto tax lawyers will cost you $1,000 an hour. But you do need a good crypto accountant, CPA. So that's someone, excuse me, that's someone you should be looking for also. Or at the very least, find out what you need to do and then make your own decisions from there. So this is the program that I put together. It's called the Elite Crypto Tax Mastery Intensive. It's 6 weeks of work. There's a recorded lecture that drops every Sunday night, hour long, hour and 15 minutes, whatever it is. And then there's a second live class, the first half of which will be additional teachings. And the second half will be answering questions that come up from anybody. And that could go as long as the questions go. So that's at least 2.5 hours a week. And if you're not willing to put that in, I wouldn't recommend you do this. I told you there's a mastermind, which is limited. The 6-week program will only have 25 people. I'm not looking to do a major big deal. As I said, I'm not a marketer. This is really to help people with their taxes. When I have questions, I want to be there to help people. Everybody in the program gets a one-on-one free consultation with me, not as a lawyer, but as a tax educator to help with this. And a couple other things, which I'll talk about in a second. The second part, the second tier, is a mastermind, which of those 25 will be limited to only 8 to 10 people for deep strategic planning and evaluation. And I think it's really, really important to do that if you have significant wealth. The exclusive, now I've never done this kind of program before, so I'm sort of in a way winging it, but I'm using my years of practice, which I'm kind of dusting off very rapidly. And I'm doing it. I've created this based on what I would want, the help I would want if I didn't know what I knew. And that's the only way I can create this structure, is based on what I think other people will want. The third thing is this exclusive access to what I call the Compass 360 tax app. It's beta. I'm going through it. I don't know if it will be 100% by the time it comes out, but it will be. It's yours for life for as long as you need it. But I'm 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 one person and I'm creating it as best I can. But I think that will make a huge amount of difference. There's a bunch of, I have access to some specialized crypto knowledge, the chatbot that I was talking about to answer questions. Um, that's really important. And I am just going to give me 1 second. I have to go to a different screen. Sorry. I need to get to. Isates, do you have I don't have access I lost it. Do you have access? Oh wait a minute, I know where it is. Okay. Can you see this? Can you guys see the screen?
Yes.
Can you see I think I stopped sharing.
No, I can see it.
You see the Elite Crypto Tax Mastery Intensive?
I do.
Okay, good. Okay, so this is a copy of the page that explains it. I've had a couple of issues with the tax, my website, because my VA who was helping me ended up in the hospital and didn't quite complete it. But so the links, the only thing that's really not working are the links. So that's why I'm walking you through this. This is basically, I'm not trying to sell everybody anything, honestly, and I'm not going to do the whole pitch that marketers do, because if you can't see the value of it, then it's definitely not for you and you shouldn't be in it. I built this specifically for people who are high end, have high risk exposure, and who need this kind of help. But when I want to show you what's included, here are my 4 pillars, which I already talked about. That will be an extensive part of the program. The program is built on that. We have proprietary AI integration. We're going to show you how to do sophisticated portfolio mastery to handle DeFi, NFTs, and cross-chain stuff. And we're going to future-proof your compliance. And this is what's included in it. The price of the course is $1,997. The mastermind is $2,997, but there's a discount for early bird. Is 6 weeks of recorded content, 6 weeks of live content, the proprietary tax app. I'll be giving you things to coordinate with and help you coordinate with, and if necessary, answer your accountant's questions based on whatever it is that I know. I'm going to give you the Gemini Gem AI tax consultant, the AI consultant bot that will help you. There'll be a 30-point checklist so you'll know what to prepare for the following year. All the sessions will be recorded, and there will be a free hour consultation with me if you need it, and I'm happy to help. If you decide that you have specialized needs and want to learn more, I'm giving the mastermind is $2,997 with a second 60-minute consultation towards the end of the program, 5 live mastermind programs. I'll be teaching AI. I will be doing some kind of AI teaching separate and apart from this, I'm sure. I just haven't actually formally put it into the program. You have direct access to me and VIP treatment, and most importantly, limited to 8 to 10 people. And the first 5 people who enroll get 15% off. So it becomes $16.97, and the next 5, 10%. And that implies also with regard to the mastermind, you get the same kind of 15 or 10% discount. And there's a refund policy. If after 2 weeks you don't think you're getting your money's worth, or it doesn't make sense for you, full refund, no questions, no questions asked, refund. I'm committed to helping you see the bigger picture and getting you on track for this. That is my goal. That is exactly what I want. There's some questions here which hopefully I've answered. I think I have answered everything. You don't have to be an AI technology person to do this. That's really important. That's number one. And I'll teach you whatever you need to know. And the second thing is that what makes this 4 pillars different from anyone else? Well, I've done a lot of research to see what kind of programs are out there. And you won't find very much at all, because yes, you can find programs that tell you what's taxable and what's not taxable. That's not going to help you here. This is a how-to course, how to protect yourself, how to work with your accountant, and how to make sure you're fully protected and protect your wealth. That's the whole gig. And this is just a recap of all that. That's my picture. I actually had a lot of fun putting this together, but I will tell you, it's a lot of work to put all these little pieces together when I'm not an experienced person doing that. So I'm going to go back to my slide. I have one more slide to show you. That's assuming I can find here. I found it. Okay, there we go. Oh, wrong one. Oh, I know. Sorry. Okay, so I have a website. It's called cryptotaxauthority.com. That site is working. What is not working are all of the links. They're working inside of it, but if the link to the page that I just showed you is what's on the screen here. Eastertease is putting that in the chat as we speak.